Welcome back to the Halftime Report. I'm Leslie Picker. Time now for the ETF Edge. Energy getting clobbered as trade tensions put pressure on oil prices. The SPDR Spider Energy ETF, the Oil and Gas Exploration ETF, the VanEck Oil Services ETF, and the United States Oil Fund all heading lower and deep in bear market territory. Joining me now is Todd Rosenbluth with the CFRA and Matt Bartolini of State Street. Guys, Todd, specifically, how are you approaching this space?
Yeah, you're getting a hit from oil prices being under pressure, and there's concerns about the global economic picture. So we think a good way of playing this is through the MLP, the transportation side of the space. So MLPX is a global X ETF that offers stability of the income stream that's there. These companies are impacted more from volumes than oil prices. So that may be a safer way of playing the energy sector, according to CFRA.
Matt, as head of Spider America's research at State Street, do you see any reprieve on the horizon for energy or anywhere in particular?
Well, I mean, I think the whole entire energy sector has been facing some weak price momentum, but also earnings momentum coming out of Q1. Earnings growth is very, very low and negative. Not a lot of firms are beating expectations. So it's going to require somewhat of a steel stomach to step back into this marketplace. I think if you pair up the drillers versus the servicers, something like XOP, they have less revenue coming from overseas. So trade impacting could be less than something like the services, which actually tend to have a high amount of revenue overseas.
Services and also just exposure to the commodity in general. Does that have a role here in terms of where you see opportunity or where you're kind of avoiding?
Well, I mean, somewhere like XOP, where it has a higher amount of mid-cap and small-cap exposure, they're going to have a higher sensitivity to the spot price of oil. And given that it's fallen so much over the last few weeks, and we have a potential impact of weakening demand, somewhere like XOP would have sort of a negative skew to it. But again, if we get a reprieve from these trade tensions, that higher sensitivity could be a benefit to those investors willing to take on that higher volatility.
Todd, how does the ongoing trade dispute kind of factor into all of this? Can you even really trade, no pun intended, what's going on right now in terms of tensions, or are you looking at kind of other areas in terms of fundamentals with these energy companies right now?
Yeah, I think you have to look towards the fundamentals and figure out which companies are going to be strongest. And then the larger cap companies that tend to be exposed more in XLE, the Energy Select Sector Spider, or VDE, the Vanguard Energy ETF, those are more mega cap oriented strategies. You can hide a little bit out from the Exxons, the Chevrons that have more stable income streams.
All right. Todd and Matt, thank you.